Hi, and a very warm welcome to our post-budget webinar. I'm Mitch, Hahn, CEO of Norden's Chartered Accountants. And before I go ahead and introduce Adam, who you can see on the screen, I want to say a big thank you to everyone who has been on our webinars during COVID and lockdowns. Two words I dislike very much. I hope we've been able to support you through anything that you've been going through, and also thank you to everyone who has joined today. It's been an eventful 18 months, as you all know, but we are, as a company, really proud of the way we've helped businesses. We've raised over 10 million for businesses in need, and we've created solutions to assist business owners to not just get through the period we have come through, but to navigate and thrive. So we're here to help, and our mission is to help everyone achieve their goals. So please get in touch if you need absolutely anything. This webinar won't last very long. But if you do need to leave, don't panic. We are recording this, which you can see in the top left of the screen. It says recording. We are recording, and we will send it out either at some point today or tomorrow, so you will get to see it. I'm grateful to be joined today by Adam Truluck. Hi, Adam.
Hi.
Adam heads our tax department, and what Adam's going to do today is going to give us a simple overview of yesterday's budget announced by Rishi Sunak. If there's anything in particular that we should be worried about, anything we should be excited about, and how it can affect you and your business. Adam, welcome. I'm not sure if anyone watched the budget live, probably a bit boring for some people, but it probably felt like there were lots and lots of announcements, predominantly in the middle of the statement. But if you dig deep within, this was pretty much a budget of what I would say a lot of things not happening. If we look at things that will be happening, it's pretty minimal with all the big announcements that have already been made pre-budget, with corporation tax rising and so on. But that said, there are some pretty interesting things and topics that come out of the budget yesterday, with R&D investment and some real assistance in the struggling retail, hospitality and leisure business. Or industry rather. So I'll pass you over to Adam. But just before I do so, if anybody at any time has any questions for Adam or myself, probably more towards Adam, I would imagine, then fire them over in the Q&A box, and we will do our best to answer them live today. Or if not, we'll get in touch with you after to assist. So Adam, thank you for coming on. Over to you.
Thank you, Mitch. Cheers for that. Hi, everyone. So before, obviously, when we delve into the wonderful budget of yesterday, I just wanted to touch on a couple of points that had already been confirmed before the budget, but just in case people are not aware of it, just in case. So as I'm sure most of you are aware, national insurance is increasing by 1.25% across the board. That's happening from April 2022, and will go on for a year. And then from April 2023, that will be replaced with what's called a health and social care tax at 1.25% as well. That will also include people over the age of state pension. Obviously, at the moment, they don't pay any national insurance tax. They will start paying this extra 1.25% from April 2023. Obviously, that's if they are receiving any employment income.
Is it, sorry, Adam, is it just employment income, or is it sort of pension income as well? Because some pension income is not taxed, is it?
No, so this is on national insurance.
So
obviously on pension, you don't pay national insurance contributions. So it's pretty much just on employment income.
Just, okay, perfect.
Yeah. Dividend tax then is also going up by 1.25% as well, which is essentially to cover all these director-owned businesses who draw a minimal salary, don't pay any national insurance, and then pay dividend tax on the rest of their drawings. So that's going up by 1.25% across the board as well. They're the main two changes that were confirmed before the budget. They weren't really spoke about in the budget. So I just wanted to cover them two quickly just before we go into everything else. So going on to, I'm going to start with research and development, because that's probably one of the biggest changes that's happened in the budget. So they're increasing the scope to now include data and cloud costs. This is going to be from April 2023, which is great because obviously with this day and age, with advances in technology, these data and cloud costs are becoming quite big. So it's brilliant that they're now going to include them. What isn't 100% clear is how they're going to define data and cloud costs. For example, with data costs, are you going to be able to claim if you purchase data from another provider, or are you only going to be able to claim the cost of creating your own database? Same with cloud. I mean, are we going to be able to claim for an entire server that's kept in the cloud, or is it just going to be for cloud software? They've not defined what they mean by these yet. I presume they're probably most likely going to be doing this in the next coming days, and at which point, we'll provide updates either on an individual basis, or we may add another little extra video for yourselves, just explaining what them definitions are. They're also going to be restricting research and development to activities carried out in the UK only. Essentially, they're following the likes of people like America and Australia, who only, provide research and development for activities carried out in their countries. The idea of it is to encourage more skilled workers to be working within the UK, rather than these companies receiving the credit in the UK, but the workers and everything are carrying on elsewhere in the EU or wherever. So since we've left the EU, they now want to encourage all the skilled workers to come here. The only issue with that is potentially people's research and development actual costs will rise. Obviously, we're providing workers within the UK may be more expensive than other countries. So that's one to look out for, which we can assist you on and help you with all that if any questions on that.
It'd be worth saying that I would imagine that that it will take longer to receive to get the R&D claim through, because I think HMRC, off the back of the budget, released a statement to say they're optimistic but also extremely concerned because of the increase, the fraudulent activities that could take place.
I imagine there is going to be, yes, people trying to push their luck, either completely criminal or just people trying to, get lucky and get through. And I imagine there is going to be a lot of work. HMRC are going to have their work cut out for them, cracking these down and working out what's real, what's not. As well as, I believe there's probably going to be quite a surge in research and development. Open up these extra costs is probably just going to make it a lot more people applying for the research and development. So I imagine timeframes are going to get longer. Yes. Yeah.
Good.
Yeah. So moving on to annual investment allowance, which is another big one they've done, which they've extended it to at the moment, annual investment allowance is up to £1 million. You can claim 100% on plant and machinery, fixture and fittings, bits like that. They've extended that now up to April 2023. So any plant and machinery and fixture and fittings bought between now and then, you can claim 100% on. Plant and machinery has actually got the super deduction of 130%. That's extended up to April 2023 as well. So on plant and machinery, if you buy it for 10 grand, for example, it's going to be 13,000 that you can claim. So that's going to be good for people looking to go green and essentially invest in, improving their properties, putting solar panels on, electric car charging points, all bits like that. The plant and machinery is going to provide a lot of deductions there and save you quite a bit of tax.
So whilst we're on that topic, a question has come in from somebody. I know super deduction was announced back in March. I was thinking about getting solar panels for our offices, which you've just touched on. Would this be included under the super deduction? The answer to that question is absolutely, right?
Yeah, absolutely. So putting in the solar panels is, it's going to go under plant and machinery, and you'll be able to claim the super deduction on that, definitely.
Great, perfect.
Yeah. All right, it's brilliant. So great time to invest in plant and machinery, especially plant and machinery. Fixture and fittings is allowable as well, but plant and machinery is what you're going to get the super deduction. So between now and April 23 or 31st of March 23 is the actual dead cut-off line. So between now and then, great time to invest in things like that if you're looking to do anything like that.
The charging points come on for if you were going to look for an electric car, do they come
yes, you can put charging points in that. Most things that are environmentally friendly are most likely coming under it. There's a few that maybe don't, and might be a bit of a grey area, but majority of things are going under that. That does then as well lead on quite nicely to the business improvements rate relief that they've included on coming in, I believe, pretty much straight away. I may be right, no, pretty sure straight away. So the business rates relief, improvements rate relief. So any additions or improvements you make to your property, for example, installing the solar panels or anything like that, there's going to be no increase on your business rate for 12 months. So businesses, for example, like hotels, can add extra rooms to their hotels and not have to pay any increase in business rates for 12 months. Also applies to businesses looking to expand their property, for example, build extensions onto their property and expand. Same situation, won't have to pay any business rates increases on that for 12 months. So leading back to before, it's a great time to improve the property, install some more plant and machinery, look to go green, look to go environmentally friendly, or just do them, improvements that you've been waiting to do. Great time to do it. So then, sorry, Mitch, I thought he was going to say something. So then going on to, coming on from business relief, staying on the business rates topic, for the hospitality sector, they're getting a 50% deduction in their business rates. It is capped at 110,000, but I mean, that's quite a nice chunk of money, which I'm sure they have been quite desperate for. An influx of cash over the last 18 months, one of the sectors who have been hit the hardest by the pandemic. So cutting business rates is definitely going to help their cash flow, and it potentially help reduce prices as well, which then is going to encourage the public to come back to spending, spending out on the high street, going to local pubs and restaurants, which also comes into the alcohol tax, which we can go into a bit later. Just encourage them back, which is going to help their cash flow as it is.
Yeah, they're really trying to help the hospitality.
They're really pushing to help them. Yeah, over the last 18 months, obviously they've been affected. Like I know several, pubs and restaurants have, had to go out of business, and just because they were hit so hard. So the guys who did survive, this is really going a lot towards helping them get back on track and obviously catch up on these last 18 months where they've really fallen behind. And obviously that cash, that up to 110,000, that cash can go a long way for them.
Yeah, agreed.
Yeah. Going on from that, they're looking. So banks at the moment pay 8% surcharge on top of their corporation tax. They call it a bank surcharge, believe it or not. They're reducing that to 3%. And the idea is to obviously help the banks and encourage lending and all bits like that. They've also increased what they call the challenger banks limit. So at the moment, any banks with turnover up to 25 million have to pay this surcharge. They've increased that to 100 million. And what that's going to do is assist these smaller independent banks, these challenger banks, to get more into the competition, and then compete with the likes of people like Barclays and NatWest and Lloyds and all people like that, and kind of just make the competition within banking a bit more fairer. And then what you might end up seeing is these smaller banks, these smaller independent banks, becoming a bit more players within the field of mortgages and lending and stuff like that, which obviously then is going to make the bigger banks try and compete. Otherwise, business is going to go elsewhere. So things like mortgages and loans, don't quote me on it, but hopefully will become a bit easier for people. A bit more choices out there, a bit more option. So that is hopefully go quite well and is looking good.
Yeah, I think over the last 18 months, we've obviously lent out, well, we've lent out, we definitely haven't lent out. We've helped, our corporate finance team have helped businesses borrow money, and a lot of the challenger banks, if they are able to lend, their rates are silly because they can't compete with the bigger banks.
They have to, yeah. Otherwise, they're just not going to. They're not going to carry on. They just won't be able to afford it. Obviously now, it gives them a bigger playing field. And
I did also read that they're trying to make the UK still an attractive place for investment or for cash deposits.
Yeah, especially after Brexit, they want to make us look, as attractive as possible to get from. Well, we're free to go all over the world pretty much now, aren't we? So they want to get investments from everywhere. And I mean, it's kind of looping back to research and development, why they're once again restricting that to the UK. It's going to encourage these other countries who are carrying on activities in the EU or wherever to come to the UK and to provide their work here and to invest their money and their time here, which is going to create jobs for people, and it's going to help the economy a lot.
And just while I know we spoke about R&D just before, but R&D is a really interesting area because there's quite a lot of things that qualify for an R&D that most people aren't aware of. So what I will say is most businesses actually do spend some kind of money on R&D. They may not be aware of it. So what I would say, anybody watching this video, get in touch, because we can literally look into the business, see if you are spending, because it's basically free money from HMRC, although it might take a little bit longer now. It is basically free money from HMRC, and it's something that we can really help you with and can really benefit your cash flow. So if you are watching and unsure whether you do qualify or think you don't, you possibly do. So do make sure you get in touch.
Yeah, no,
sorry,
I completely agree.
Adam, over backed up.
Okay. No, absolutely fine. No, I completely agree with you. There's a lot of people out there that don't realise, what you're doing is research and development.
Yeah.
So if someone's willing to give you some money for it, why not?
Exactly.
Yeah. So next point I've got is national living wage. It's big increase. It's about 6%, I believe. It's increasing by up to £9.5 per hour. Which is obviously great for the lower paid workers. That's coming in from April 2022. And essentially it's looking at giving, full-time workers on the lower end minimum wage, extra £1,000 a year, which is great. More to help them. Obviously they've had quite a hard time. Well, we've all had a hard time, but, to help them get by and get back on the track. Following on from that, universal credit as well is also helping the lower end of workers. So they're reducing the taper relief. So the taper relief is if you're on universal credit and you're working, for every, depending on whether or not you receive help for your housing costs, your taper relief is either £515 per month or £293 per month. And essentially every pound over that you earn, you get deducted 63 pence off your universal credit claim. They're reducing that to 55p. So it doesn't sound great. I mean, it doesn't sound massive on paper, but once you add that up for every pound and over the year, it's another £1,000 for a full-time worker over the year. So essentially someone on the minimum wage could be looking at an extra £2,000 a year, which is great. And I'm sure that will go a long way in helping them. So it's great. Also, sort of following on and kind of goes in with that is apprenticeship funding. They're putting a lot of money into apprenticeship funding. So £2.7 billion they're putting in by 2024-25. And essentially what that does is helps small businesses take on apprentices, train them up, and pay them a wage. And once again, it's all linked back to trying to encourage the skilled workforce in the UK. So all these young people, who are there and ready to be trained and taught a trade or anything, can get into work. And it's going to encourage these businesses to take on the younger people who haven't worked before and teach them and send them to college and train them. And over time, obviously with that, you then build a skilled workforce within the UK, which other countries are going to want from us.
Yeah, there's lots of, I know I'm getting a lot of messages on LinkedIn about the apprenticeship schemes that are going on at the moment. So there's a lot of companies that are kind of offering it as well. But if you do want to learn more about that, we can assist, and we can kind of guide you in the right direction of using what the government are proposing to help in your business and employing staff. So I think it's a really good one because
and once again, it all links back to more people in work, the more people working, less strain on this system. Things like universal credit and PIP and bits like that. less strain in the system, more money they can spend elsewhere, and it just snowballs essentially and just gets better and better as it goes.
Sorry, I was just going to say, it's quite interesting because out of everything that come out of the budget, they're probably the only things that are kind of relevant to.
There was a lot of talking within the budget. A lot of it does not affect, the everyday working person.
Yeah.
There's things like your passenger duty on airplanes and your alcohol tax and stuff like that. Okay, yeah, it's less cost for things, but as far as like your income goes and your tax goes, it's not really affecting that side of it. There wasn't a whole load. There was a couple of bits they didn't mention, which I like to touch upon because there's
a really big one here that they didn't mention, which I'm guessing.
I'm guessing you mean capital gains on that one.
Absolutely, because there was a lot of shock they never did it previously.
It was pretty much a given, wasn't it? Everyone thought they was going to do back in March on the first budget. They didn't do it. And then I should really just tell them what it is, shouldn't I? So potentially looking at raising capital gains tax to fall in line with the income rate. So at the moment, capital gains tax, not including residential properties, but capital gains tax is 10% in the basic rate, 20% in the higher rate.
What sort of things fall into capital? It's worth saying what sort of things that would fall into capital gains.
Yeah, so essentially it's any long-term asset that you have that makes a profit, that increases in value over the time. I touched upon residential properties. Properties is a main one, not including residential properties. So commercial properties, land, if you own a piece of land in itself, that as well.
Shares.
Then you got your other,
shares, if you sell business.
Stocks and shares, businesses. If you own a business and you sell your business, that's going to be a capital gain. Crypto is falling into capital gains now. Crypto is becoming a big thing. A majority of that is falling into capital gains. There is other assets. So, for example, classic cars. If you've got a expensive classic car that can go up in value, that could potentially fall under capital gains tax. It's essentially any long-term assets, so not necessarily something you buy and then change 6 months later or a year later, but something you buy, keep for a few years, and then it's gone up in value and you're going to sell. So anything on that, there is a £12,000 allowance on it, separate allowance, separate to all your other income. So if your profit that you make on it is less than 12,000, you don't have to pay any capital gains tax. Residential property, different set of rules. It's 18% in the basic rate, 28% in the higher rate. And up until yesterday, you had to file that and pay that within 30 days of you selling that property. Since yesterday, midnight last night, that is now 60 days, which is actually, it's quite a big, bit of breathing space that is now, because sometimes when you've got 30 days to go and find a completion statement of a property you bought 20 years ago, it can be a bit fun. So giving us 60 days now gives you quite a bit of breathing room and takes that bit of strain and bit of stress off it. So that should help. Other than that, nothing was mentioned on capital gains. So no increase in rates, no changes to the payment days and everything else other than capital gains. There was a lot of rumours going around that the £12,000 annual allowance was going to come crashing down to about 4,000. None of it. Not peep.
That doesn't mean it won't happen.
Doesn't mean it won't happen. Potentially, it might happen in March. Some people are thinking, are they going to let us get past Christmas? They've sort of looked after us a bit here. Come March's budget, are they then going to bring it crashing down then?
But what I will say is that anybody that is on here who's got a business and are looking to sell over the next 12 months or 2 years, it might be worth having a conversation with whoever your advisors are, because if at the moment there has been no changes, but obviously we don't know what they're going to do in the future, but it may be worth looking at bringing it forward to take advantage of the fact that nothing has changed with the capital gains tax rates. So yeah, definitely worth a conversation. I mean,
there was one other small thing that they didn't potentially need to mention this, but I thought they would speak about it within the capital within the budget. So there was two things coming into force very, very soon, coming April, which is making tax digital for landlords and the self-employed, and the basis period refund. So I'll start with basis period because it's much simpler to explain. So sole traders, for example, can have any year end. It's usually 12 months after they started trading. So it could be June, could be September, could be anywhere. The revenue wanted to change it. So all self-employed year end is 5th of April. It all falls in line with the tax year. Reason they wanted to do that is because of MTD. So MTD, which is making tax digital, or it's actually called MTD ITSA now, which is making tax digital for income tax and self-assessment, which is a bit of a mouthful. I think we'll just, for the sake of now, we'll stick with MTD. But so the idea of MTD, they've already done it with VAT. So if you're VAT registered, you're already fully aware of what's going on. But you have to keep all your receipts, invoices, bank statements, everything digitally through one of the, there's plenty of software out now. You've got QuickBooks, Sage, Xero. There's a whole, selection of softwares you can use. But you need to use one of these softwares to maintain all your thingies, all your receipts and invoices. And essentially, you'll then have to file that quarterly with the revenue. So whereas sole traders and landlords are used to just filing one tax return each year at the end of the year by January, they'll now have to, it's 5 returns they'll have to submit now. They'll have to do 4 quarterly ones throughout the year. And then at the end of the year, within 9 months of the end of the year, they'll have to do an end of year report, which would essentially be your normal tax return. But you have to do 4 extras throughout the year. So that's a big change coming in. They have put it all off now until April 2024.
How many times has been put? It's been put back a few times now.
It's been put back about 3 times. So I've, off the top of my head, originally it was going to come in April 21. I think it was originally coming in, and then April got put off to April 22. Now it's April 24. What I would advise people is don't wait until the last minute to get on top of this. We've seen it delayed a couple of times, but what happens is people think, oh great, it's delayed, I can leave it. And then it does inevitably get pushed to the back. And then before you know it, the new deadline is on you and you're panicking again.
Yeah, I agree. And I think, but what I will say is that although they're bringing it in and it is a burden, it also can be used to any business owner or landlord or sole trader's advantage. What it will allow you to do is see up-to-date, accurate information of where your business is currently at, which is absolutely key to making any type of business decision. Always say to our clients, you have to get up-to-date information compared with forecasts. By HMRC bringing these rules in, it actually makes you have to do it.
It does, yeah. So it sounds, when you just kind of look at it on paper, it sounds like a horrible, tedious job, but it does come with a lot of benefits. For like you say there, it allows you to see, at any point during the year, it allows you to see where you are with your business. It also stops the whole me chasing you for paperwork constantly, because it's there. All I need to do is just log on and it's there. So it makes things a lot quicker. You ever need to find a receipt, it's there. The revenue ever asks you to prove something, information is there. And I have seen it with VAT, where MTD is already in with VAT. I'm not saying it will stop revenue inquiries. It does help reduce them though, because information is easily accessible. And it's all being run by a regulated software.
But it also allows anything that, to review the figures consistently, to make sure that you're set up tax efficiently, make sure the corporate structure's right, make sure that, you're doing all the right things to potentially reduce that tax bill at the end of the year. Gone are the days where you have to, where you wait until the end of the year, because the revenue is now they will be seeing up-to-date information. It's going to be very difficult to adjust anything that you need to, or do whatever you need to do. So I think it's really important to review the figures.
What they are saying at the moment is that although you have to file these quarterly returns throughout the year, you don't have to pay the tax until you file that 5th return, your end of year return. you won't have to pay the tax till then, because that is when your adjustments and stuff go through.
Yeah.
Because obviously you might be filing your quarterly reports throughout the year, but there'll be some things, for example, PAYE income, which it's all adjusted at the end of the year adjustments on, and there's other things that, so you can't reach your final tax bill until after the tax year, because there's things that happen between now and then. So at the moment they are saying, yes, we'll give you an estimate of what your tax bill is, but that doesn't have to be paid. It's still going to be 31st of January every year. That tax is going to have to be paid. Whether they change that once they've brought it in for a while, I don't know. But at the moment, that is where it stands.
It's also quite interesting because I know KPMG are consulting for HMRC at the moment about an internet sales tax. They're looking to potentially bring in, which could be interesting.
Yeah. It's not surprising, to be honest. With the last year, everyone's gone to internet, haven't they? The likes of people like Amazon and stuff like that have been booming. I think they've had some of their biggest sales they've ever had, haven't they, over the last 18 months, while the rest of us were struggling. They were loving it. So it doesn't surprise me that they bring something like that in. Yeah,
I don't know if that will come in March, but I do know the KPMG yesterday confirmed they are consulting on it. I thought the best change was the alcohol, the new alcohol. Touched briefly before, but I
think that's what we all think. I think everyone's sitting there waiting for me to get onto that. That's what everyone wants to hear about, isn't it?
Yeah. I'll let you explain the changes.
Yeah. So essentially, they're simplifying the alcohol duty tax. At the minute, it's just a chaotic kind of way of working out how much you pay tax on what August. But essentially they're making it a very, very simple way now process of the higher the strength, the higher the tax. And what that is essentially going to do is it's going to make these low cost higher alcohol just a thing of the past. It's just not going to happen anymore. It also will, there is some kind of like red wines and stuff like that, but that are not low strength like wines and that, which will bring the cost of that rosé, for example, not very high percentage, but you can pay quite a bit for one.
If you want a cheap night out, you should be drinking rosé, right?
Rosé or draft beer and cider.
There we go.
Because draft beer and cider have an additional about 3% being reduced by, so you're looking at, it's going to save you about three pence a pint and stuff like that. By the end of the night, might be able to.
It adds up.
But essentially, draft beers and ciders, so restaurants and pubs serving them, they're going to have to pay less tax on it, which is great for especially like little community pubs. 75% of their business is going through that, so it's going to be great for them.
Yeah. I don't know. Have you got any more to add? Because I've got quite a few questions. Have
you got some? You go as questions. See what people have got to say.
Okay, so we've got. Well, that's quite funny actually. How much of an impact do you think the alcohol duty tax cuts will have on British beer and wine producers, as well as overall public health? Good question.
So there is, on top of the bits I've just mentioned, they're bringing in new even lower rates for producing low rate alcohol. So anything, I believe, it's under 3.5%, there's going to be cheaper rates. Obviously that's going to then encourage brewers to start making these drinks and start pushing these drinks out, which is then going to give the consumer and the public better options and more options. They don't necessarily have to choose this beer, for example, which is a higher strength because it's the cheaper one, and it's going to give people more opportunity, more chances to be safer and to drink more sensibly, and not to push it. But then it's going to help the brewers as well, in the sense of they're going to be able to, their profits are going to be higher because they're paying less duty tax, straight out of the gate, but they're going to be able to expand their selection, expand what they're providing to the public. So it's going to help them in that respect as well.
Okay, good. Another question. The 50% cut in business rates relief in the hospitality, leisure and retail sector is a huge step in the right direction, but will we see further announcements looking to aid these sectors?
Possibly. So at the moment, as of beginning of this month, yes, it is still October, beginning of this month, the VAT rate for hospitality, entertainment, leisure sector was reduced to 12.5%. That is in place until March 22. There is a lot of calls to make this permanent and keep that there. And there's a lot of companies
really shouting about it.
They're making a lot of noise about it. So whether we see something in the next budget, obviously it finishing in March 22, around that time, maybe we'll see something then making that permanent. I can't guarantee it, but I mean, if they follow suit of what they've done in this budget, essentially, which is a lot of help towards that sector, it would be great for them to keep that at 12.5% and make that permanent. That'd be great.
I think a lot will depend on what happens through the winter months.
Yes.
Hopefully we don't go into lockdown. We're very much prepared if we do, but depending on how much support, because if we did go into some kind of lockdown, the hospitality industry will be affected hugely, which means that they'd have to offer far more or further, a lot of further support, not just a small amount in the next budget anyway. So personally, I think following on what you said, I think that they will have to do something.
I think they're going to have to put something in, because although yes, the sector is coming back and they've put a lot of things into great, I still think it's very fragile. Like you say, if something was to happen during winter and we was to go into another lockdown, I mean, I hope we don't, but if we was to, how are they going to fare? They've got to do something, I think, at least for the next couple of years to essentially help this sector get back to where it was and get back on its feet. I mean, it's a tough enough sector as it is, let alone without all this on top.
Yeah, agreed. A few more questions. I want to get through these. The passenger duty lowering for domestic travel has been warmly received, but won't it encourage more people to take flights and therefore increase their carbon footprint?
I mean, you say warmly received. It depends who you're looking at. There is a lot of kind of backlash coming from this for that exact point of all these other parties, all these economists are saying that exact thing of it's just going to increase the country's carbon footprint. I mean, it's right before, I think next week, they've got COP26 climate summit. So it's a strange time to bring all this out when that's right on top of you. But there's essentially two ways of looking at it. You've got Sneak's way of looking at it in the sense of, yes, we are reducing the taxes for domestic flights. So there is going to be more domestic flights to Scotland or Manchester or wherever you're going. But we are increasing quite heavily the taxes on long haul flights. So what he believes is the situation is, although there's going to be more domestic, there's going to be quite a big cut down on long haul, which obviously long haul is going to produce more carbon footprint because of the distance. So they believe the long haul reductions are going to outweigh the increase in domestic. There's a lot of
And also, as well as that, I think with they're obviously, like what you said before, it's a great time to go green because they're investing heavily in sort of that area of the country's carbon footprint, like trying to make everybody go electric with the cars and the charging and the solar panels. So I think that also needs to fall into that question as well as part of the answer.
Yeah, I wouldn't be surprised if we see between now and the next budget, a lot of things with trains and stuff like that as well, where they bring in some kind of, reduction in train fares or something like that to try and encourage, although being cheaper, although it's now cheaper to get a flight within the UK, I think they're going to want to make it so it's still cheaper to get a train. Because obviously trains...
I'll hold you to that prediction.
Don't hold me too much. I wouldn't be surprised if they do that though. So you can't guarantee it. I better cover myself now, but can't guarantee. I just feel like they're going to have to, especially with the last, obviously 18 months. Once again, it plays on a lot of things. The last 18 months, a lot of people, I know personally myself, I'm not looking to go on holiday abroad at the moment, at least for another year. I'll be doing like domestic holidays. So like for example, if I was to go up to Edinburgh, I probably would get the plane now. And I think a lot of people are going to be looking like that. So I think they've a bit underestimated how much the domestic flights are going to increase by, my personal opinion. I don't know whether, whether that's the right thing or not. That's just my opinion, but.
Yeah, okay, good. 2 more questions.
Yeah, come.
As the minimum wage is going up, do you think the government expect employers to increase other pay grades?
I think they'd like them to.
Yeah.
It's not something you usually see happen now, I'll be honest with you. As the minimum wage goes up, it's usually only the minimum wage employees that will get the increase. I think it does depend quite a lot on the employers as well. Obviously, if you're working for a good employer, like I am, for example.
Fantastic. I think it's one of the best.
I think they will look after their staff, and as they get, not just in the minimum wage, but as they get kind of reductions in other things that have come out of the budget, I believe there will be some companies out there who pass that on to their employees. So I don't know if necessarily it will be 100% because of the increase in national living wage, but I wouldn't be surprised if you do start seeing things like that, though.
Yeah, and I think just to touch on that, I think whether it impacts employers directly from a cash perspective is questionable. So I think there are other ways to look after employees other than just pay rises, right? Because I think there's healthcare benefits, bonus.
Yeah, no, definitely.
There's different ways to assist. So the government are doing whatever they can to try and the cost of living's gone up. Is it 6%? I read that. I think
it's quite a lot.
Yeah, but I think there's only so much an employer can do so quickly in order to be able to sort of keep up.
Yeah, and sorry, go on.
No, carry on.
I was going to say, just like looping back to the beginning, like it doesn't necessarily have to be cash you give your employees. Yeah. You can get a couple of electric car charging points installed outside your office for use of your employees. They're not actually receiving anything. You're getting a 130% tax deduction for that, and that's quite a good benefit if you ask me. If electric car, if I could just come to work and charge it at work, it's great.
It's something that we've done. I thought I'd just say that for our clients and for our teams. Like I was saying, I think that although I think other areas to benefit staff and your internal teams and to look after them, I think are more beneficial than just a pay rise sometimes, that are far more valuable. So I think it's worth looking in those areas. For the person asking that question, look at those areas as well, because I think it's really important to look after your team. And there's also a big surge in recruitment as well. You have to make yourself appealing, otherwise you're going to lose key members of your teams to competition or to other companies. So I think that employers should be always looking to increase sort of the benefits to their teams.
Yeah, sometimes there's things that are worth more than money. So yeah, no, definitely.
Got to be careful what I say here, because I know we've got quite a few people on for the office.
We're all writing this down. We all expect
it's something we're looking to. We are doing anyway, but
we all expect electric cars at Christmas and stuff.
We definitely got 2 charging points coming. There we go. One more question. Are there any mentions of disguised remuneration schemes? If they're increasing dividends tax, will company loans be affected? Good question.
I personally haven't heard of. I mean, there is, the main disguised remuneration scheme that's going on at the moment, which obviously a lot of people are aware of, which is going back over several years and looking at these loans that were, say loaned out to employees or directors, and then never had to pay back. And yeah, it's a whole thing going on. I don't know of any new ones coming out, whether they're going to pick them up and push them out over the next year or so. HMRC are stepping up a lot on their inquiries since over the pandemic. Obviously, they were flooded with other things, but they are picking up on their inquiries now. We're starting to see more come in, so it wouldn't surprise me if they start picking up on things.
I think inquiries always go up. I mean, there's lots of inquiries into disguised remuneration schemes at the moment that it goes beyond accountants. It's almost with legals and barristers and so on, but they're in full control of it. But I don't think there was anything in the budget with regards to it.
There was definitely nothing in the budget about it. Yeah. I've not seen anything sort of bouncing around otherwise. I know they are starting to, a lot of these disguised remunerations, and usually what they do is they raise a county court judgment to protect their position, because obviously after a certain amount of time they're not allowed to go into it anymore unless they've got a county court judgment. They're starting to do a lot of standstill agreements now, which basically says, look, we're not going to raise a county court judgment against you, but you need to sign this legal agreement that says we can still look at it.
Yeah.
So there's a lot of them going around at the moment. There's nothing new though. Just put it that way. There's nothing new going around that people should be wary of.
Cool. Have you got anything else to add, Adam?
No, I think we've covered the main points. Unless there's any other questions going on?
No more questions, but what I will say is obviously with HMRC up in their inquiries and so on with furlough, there is a insurance that you can get. And it's worth mentioning that it's not through us, it's with a partner of ours, that it's a small cost every year. But if any inquiries come and it goes further, which is quite possible with everything that's happened, then it can come from
sometimes it's just a name out of a hat.
Exactly, it's just a name out of a hat. It's definitely worth looking into or speaking to us about, because it will cover you for any inquiries legally and financially. So it's definitely worth looking at. Do get in touch. It's funny, I just had a message come up saying mention it, because it is worth mentioning it.
It is. I mean, it's obviously for, I'm not sure how much off the top of my head it does cost per year, but revenue sorry?
Few £100, I think it is.
Yeah, it's like 200-300, something like that, isn't it? But revenue inquiries can run into their thousands.
Yeah.
I've had inquiries that have gone on for a couple of 2-3 years, and they can rack up the fees a lot.
Yeah.
Yeah. So obviously with the insurance, you're covered for that. You haven't got to worry.
Yeah, good. All right, well, look, we will keep everybody informed of any changes. As we all know, the devil, especially, Adam, the devil is always in the detail, which sort of tends to come out over the forthcoming days and weeks. What I will say is we will keep everyone updated. So sign up to our newsletter. You can do that via our website. We'll be sending out any updates, any detail that you all need to see of everything, everything and anything that you need to know. Adam, thank you so much
no problem.
For coming on. Really appreciate it. Thank you to everyone who asked questions. Thank you to everyone who's been with us the whole time. And remember, if you're a business owner who'd like any assistance in any area, whether it be compliance, whether it be advisory, or exploring options of raising finance, I know that's a huge topic, especially over the last 18 months. Please do get in touch. We're obviously happy to help absolutely anybody who feels necessary or who needs the assistance. So thank you very much, and we hope to see you soon.
Thank you.